Hey everyone, thanks so much for joining me today. My name is Mallika Bender and I am an actuary. During my career, I've worked for insurance companies and consulting firms all around the US and around the world. And now I work for the Casualty Actuarial Society, which is one of the two organizations in the US that helps students to become actuaries. So today I'm really excited to tell you guys more about what actuaries do and why this career could be a great choice for students that like math and data. So if you've never heard of an actuary before, you're probably not alone. When I was in high school, I never heard the word actuary. All I knew about what I wanted to do as an adult was that I wanted to make a lot of money. So I thought, okay, I'm going to go to college and I'm going to become a CFO or a chief financial officer, even though I had no idea what they actually did for their work. I was pretty good at math in school, but I didn't know what I wanted to choose as a college major when I graduated. So in college, I started tutoring math and statistics to make some money on the side. And doing that really helped remind me how much I enjoyed being able to tell stories and explain the world through data. So that's when I decided to become a statistics major. Um, but I still didn't really know what I wanted to do with my life after graduating college. I had a few summer internships, but I wasn't sure that those particular types of jobs were right for me. So, my senior year of college, I picked up a book called Careers for Math Majors, and I hoped that that book would help me to figure myself out. And the way the book was set up was it was in alphabetical order. So, the first career listed was accountant, and, that didn't really excite me. It sounded a little bit boring. But right after that, in the A section was actuary. And what I learned from that book is that actuaries use their skills with math and data to help protect people from risk and uncertainty. They look at risks that might happen and try to quantify the financial implications, or in other words, how much it might cost. And they use mathematical models to help people and companies make decisions about how to manage that risk. Of course, the thing that stood out to me in this book was that actuaries have a really high earning potential. In other words, you can earn a really great salary as an actuary. In recent years, entry-level actuaries have been earning around $60,000 to $80,000 when they start their careers, and then experienced actuaries can earn more than $250,000 a year. So it's a great way to earn a comfortable living and doing something that you like. Um, my senior year of college, I was really ready to be done with school, and I learned that you don't need to go to grad school to become an actuary. And that's also great because college is expensive enough, and student loans are can be really tough to pay off. But even though you don't have to go to grad school, you don't stop learning after you finish school when you become an actuary. Actuaries take actuarial exams to learn the skills that we need to do on the job. I personally was never intimidated by taking tests, so this didn't sound bad to me. Plus, a lot of companies will pay for your exam fees and study materials, and they give you time to study at work. And when you pass an exam, most employers will give you a salary raise and sometimes a bonus. And actuaries that earn a credential, meaning they pass all of their exams, earn even higher salaries, and it's a lot easier for them to advance in their careers. So that really ticked a lot of the boxes that I was looking for in a career. I'm also someone who can get bored easily. And I loved learning that becoming an actuary offered a lot of different types of work to choose from. And you don't have to get stuck doing just one thing for your whole career. So after reading that, I stopped reading the rest of the book. I stopped at actuary. I signed up for the first actuarial exam. I studied and I passed the exam, and I was able to get an entry level job in an actuarial role when I graduated. So, today I want to talk more about what actuaries really do in our day to day work. But before I talk about that, it's important to understand a little bit more about how insurance and risk works. Insurance, as you may know, is different from most other products that you buy or sell. When you're selling an insurance product or when you're selling a regular product, most of the time, you know how much it costs to produce that product because you know the cost of the materials and the labor that it took to create it. So the price that you charge is based on those costs. But with insurance, you're selling a promise that your company will be there to create a financial safety net if a certain type of unwanted event happens. So, in order to do that, they need to have some sort of estimate or guess of how likely it is that that unwanted event will happen, because it doesn't happen all the time. And when it does happen, how much does it cost on average? And if there are any differences in those estimates for different groups of policyholders. So, all of that requires a really strong understanding of how the business of insurance works, as well as the skills to analyze lots of data and build models that help you predict these future losses. And that's where actuaries come in. So, like I mentioned, actuaries can work in a lot of different types of organizations. Insurance companies are the most well known, but you'll also find us in consulting firms, employee benefits like health insurance and retirement funds, banking, government, and even big tech companies like Uber and Google. I personally have spent my actuarial career focused on property and casualty insurance, or we sometimes call it P&C. And the work that we do covers very specific types of risk. So, property and casualty. Property is the risk of loss or damage to things that you own. So, like your home, your car, or a boat, or even, your cell phone. Casualty is also sometimes called liability insurance. And this comes into play if you or your business is found responsible for some harm that happens to another person, which we call a third party, or harm that is caused to that third party's property. So examples of that could be workers' compensation insurance for an employee that gets injured on the job, or medical malpractice insurance for if a patient has a problem that happened as a result of their interaction with a medical professional, or in car insurance, if you get into an accident and you damage somebody else's car, liability insurance would help pay for their damage. If you own a small business, for example, you would definitely want both property and liability insurance. You'd want to protect your business property from damage or theft. And you'd also want to be able to afford to pay if, for example, a customer slips and falls while they're visiting your business. So without insurance, those costs could actually put you out of business. That's why it's so important. So actuaries are really essential to the functioning of that whole system of insurance. And we do a lot of different things, different types of work, but the two that are biggest, I would say, are pricing and reserving. So starting with reserving, at any given time, if an insurance company goes out of business, they would still have to pay for any claims that they insured up to that point, right? So reserving means that we make sure that insurance companies have enough money on hand to pay out all of the claims that they've promised that they'll pay out. And I've spent a lot of my career doing reserving. So let's talk about an auto insurance example. The moment that you get into a car accident, your insurance company needs to have enough money on hand to pay for it. And that's even if you haven't reported it to them yet. So it might take you a few days or weeks to report the accident to your insurance company. And then you'll talk to a claims handler who will work with you to make their best estimate about how much your claim is going to cost. But even that can take some time if they have to come out and do an examination, or they might get you to take your car to the auto shop and they'll tell the insurance company their estimate of how much it will cost to repair after they've taken a look. So while the claims examiners are looking at each individual claim, those amounts of how much it was going to cost, or those estimates, are changing over time as more information comes in. Now, actuaries, we don't look at each individual claim. We look at the entire bucket of claims that an insurance company is responsible for in aggregate. And we try to fill in that missing information about how much the cost is going to change over time. So the company has enough money in total now to account for it. And that can include estimates of how many accidents have actually happened that could result in an insurance claim, or really more, how many accidents have happened yet that we don't know about, and where we think the costs will end up once all of the claims are finally settled. To do that, we look at a lot of past data about claims that were reported, how long it took for them to be reported, and how much the value has changed over time. And we try to find patterns in that data. We also talk to other people in the business to learn if anything changed in the past period, or if it's expected to change in the near future that it could impact those patterns. So for example, if your company started working with a new auto shop that processes their claims really fast, that would actually change the patterns, and actuaries have to take that into account when they're predicting what's going to happen in the future. So we put all of that information together to come up with an estimate of the total cost of the claims. And if we don't do this right, the insurance company could actually run out of money and not be able to pay their obligations to their policyholders. But also, we could overestimate this amount, right? And then the company might unfairly overcharge their customers, which is another piece of what actuaries do, which is called pricing or rate making. So once we know how much those past claims are going to cost us, we still need to figure out how much we should charge for future claims that haven't happened yet. In other words, how much should policies that we sell in the future actually cost people? So actuaries that work in pricing also look for patterns in past data, but we have sort of a different goal. We use that past data to determine how often do different types of unwanted events happen. For example, if you have a pool of 1,000 drivers, how many of them will have an accident in the next year? Or how many of them will have to deal with theft or vandalism? Or how many of them will, accidentally scrape another car while they're parking? And we can actually see that in the data that we get in an insurance company. And then we look at that past data to determine how much those different types of accidents cost to insure. So we take into account, how the frequency and cost of those events also maybe changed over time, like over the past 5 years. And then we make assumptions about how they might continue to change in the future. Because you're not selling that policy today, you might be selling it a year from now. So it has to be adequate for what it's going to cost a year from now. So putting all of that information together helps us get an overall estimate of how much we need to charge per policy. But it actually doesn't stop there, because, maybe you're a really careful and cautious driver and your friend next door takes more risks when they drive. Or maybe you park your car in a garage and they park on the street. Or maybe you have a very inexpensive car and your neighbor has a luxury car. So do you think that both you and your neighbor have the same level of risk? No. And so maybe you shouldn't pay the same amount for your insurance. And actuaries can actually estimate how those different risk profiles cause variations in the overall average loss that we estimated before. So we can help develop different prices for policyholders that have different levels of risk. And that makes insurance pricing more fair. Now, I also mentioned that we have to take into account how things are changing over time. So in our auto insurance example, that could be how repair costs are changing, how medical costs are changing over time, or how vehicle safety features or traffic laws are changing, or even just how much people drive, because we want our future costs to accurately reflect those changes in the environment. And one really interesting example of this was in 2020 when COVID started, and we had stay-at-home orders that were issued. all of a sudden, people who were commuting back and forth to work every day just completely stopped driving for months. And if insurance companies had just kept charging the prices that they charged before, most people would have paid a lot more than they needed for the insurance for that year. So, what actually happened was many insurers and their actuaries calculated how that overall reduction in driving by the population would lower the costs overall. And they issued refunds to their policyholders to account for that lower driving. And then, as people started slowly going back to work, the companies had to continually adjust to that gradual increase in driving and return to driving patterns from before times. But it's not even clear that driving patterns went all the way back to pre-pandemic levels. So that's an example of a challenge that actuaries have to face and incorporate when they're working in pricing. Accounting for all those changing environments and changing profiles of risk, or just variations in profiles of risk, is, I think, a really exciting part of the work. And I've always loved working in pricing as an actuary. So I mentioned actuarial exams, and I want to talk about that a little bit more. And I know that can be really scary to some people. Actuaries often go through a series of exams. It can be up to 10 exams, plus online courses, plus some college credits that you need to achieve a final credential. And it can take several years to get through that process. A lot of people start during college, taking 1 to 3 exams during that time, but then pretty much everyone proceeds to take exams when they're working in an actuarial analyst role. Exams aren't all bad. One of the benefits of exams is that you don't have to go to grad school or to get an advanced degree to become an actuary. And you don't even have to major in actuarial science, because these exams make sure that all actuaries have the specific knowledge that they need to do the work. In a lot of states, regulators actually require insurance companies to have a credentialed actuary sign off that they're reserving and pricing in a responsible way and in an accurate way, in order to ensure that they'll have enough money to pay their obligations to their policyholders and that what they're doing is fair. We actually have exams specifically covering reserving and pricing methods like what I just described, as well as statistical modeling and other advanced topics like reinsurance and enterprise risk management. So the actuarial exams give both the insurance company leaders and regulators confidence that actuaries are going to do the work right, no matter what their background is. And, I mentioned before, so I don't want to forget, that when you pass exams, most companies give you a raise for each exam that you pass, and they might even give you a bonus if you pass on your first try. And even bigger raises or bonuses when you get your associateship or fellowship credentials, which are those ACAS and FCAS symbols that I put on the screen. So that means that you're set up to keep advancing and having more and more high earning potential for the rest of your career. But, I don't want to sugarcoat it too much. Actuarial exams are not easy, and you have to do a lot of them. So like I said, most exams are taken while you're working, and you can often study during work hours, but you still have to figure out how to balance your work, your studying, and having a social life during the early part of your career. So we actually have another session that you can watch later today called Hard Work That Pays Off, Study Tips for Crushing the Actuarial Exam Path, where 2 actuaries share how they took on the challenge of exams and came out successful. And I think if you watch that, you'll see that you can do this too if you set yourself up right for success. So, so far I've really loved my career as an actuary, even the exams part. And I want to talk a little bit about why. I mentioned earlier how I love being able to tell stories and understand the world through data. And as actuaries, we get our hands on a lot of real world data that helps us understand how risk is changing and evolving over time. And we can use that data to predict how it will change in the future. So that means we can help to protect people as risk changes and evolves. And with challenges like, climate change, the evolution of the internet and AI, and constant technology advances all around us, there is really a lot of change that actuaries are needed to help quantify. So I love that my work as an actuary has an impact on real people. And we all experience risk and insurance. We all experience risk, and we all need insurance sometimes to help keep us afloat when accidents happen. I love that my skills were transferable all over the world. During my career, I started off working in Washington, D.C. And when I finished my exams, I was able to move to Australia and work as an actuary there. And now I'm back in the US working in Philadelphia. I worked on a lot of different lines of business, from auto insurance to business insurance, professional liability, farm insurance, cyber insurance, and many others. And I got to work in both insurance companies and consulting, which means you help a lot of different companies manage their risk in a variety of ways. So one thing I can personally say is that I was always learning, and I never have gotten bored with my work as an actuary. And I love that I can do all of this and earn a really great salary that lets me live my life outside of work the way that I want to. So if these are things that you value in your future career, then maybe being an actuary is the right move for you too. So before I leave you, I want to share a couple of resources. If you're intrigued and interested in learning more about being an actuary, I encourage you to check out beanactuary.org. That website tells you more about what actuaries do, where we work, actuarial exams, and how to get started. And it also shares resources like scholarships and diversity groups and summer programs for high school students. So that's www.beanactuary.org. And then for college students, the Casualty Actuarial Society, where I work, has a free membership program for students who are considering an actuarial career or are taking actuarial exams. And that's at casstudentcentral.org. You can sign up for that free program to get access to resources like study kits and jobs and internships listings, or our summer program, and different opportunities to build your skills and build your professional network. And I'll say again, it's all free, so it's definitely worth checking out and signing up. So that's all I have for you today. Thanks again for taking the time to join me. And I hope you enjoyed exploring this awesome career as an actuary for students that love math. So thanks again, and see you next time.